This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This is a lecture on Chapter 10 of the Paper F9 course notes, budgeting. Now, in fact, I'm not going to talk through all of this chapter because, well, two reasons. Partly because a lot of this chapter really is revision of what you've done at Paper F2, or, as always at university if you are exempt, and also because most of the chapter, the notes are reasonably full. You should be able to read through yourself without me reading them to you. And so I'm afraid that most of this, I say I'm afraid, it shouldn't be a problem. Most of this you are going to have to read through carefully because certainly most of the questions from this chapter will be written essay questions or parts of questions, but it'll be writing about the reasons for preparing budgets and so on. You can be asked to prepare a budget, certainly. There's an example on page 47, but I think the example is relatively easy, and a combination of the example and the answer at the back of the notes, it should be very clear what's happening. It's not difficult. Any problem in the exam would just be you'd have an awful lot to do in the time, so it's speed and efficiency. But otherwise you must read this chapter carefully. The one bit I will go through though, partly because the words that weren't used I don't think in Paper F2, and also as a link to one of the later chapters in the notes, is page 49, where it says types of budget, and it does link shortly to an example on the next page. So if you turn to page 49, you'll see a heading, types of budget, which I can't spell, sorry, types of budget. And let me explain what we mean by fixed, flexed and rolling budgets. But listen carefully because I'm actually going to talk through them, through the second two certainly in a different order. But first of all, the fixed budget, which I never like the name fixed budget, but regardless. What it is, I'm sure you're aware, wherever you work, that most companies, it's not a rule, but most companies generally, perhaps, depends on the year end, but if the year ends December, perhaps in October and November, they prepare a budget for the following year. I say if your year ends December, I don't know, in November perhaps 2009, you prepare a budget for the year to December 2010. Now, I keep saying it's not a rule, it's up to the company when it does its budgets and what period it does it for. But that's normally the case. It's usually a budget for the following year. And that budget we call the fixed budget. I'll explain why in 1 second. But that is your fixed budget. I'll say sorry. I'll say for a third time. It's perhaps November 2009. I've done my budget for 2010. I don't know, maybe we've got, let's suppose we've got a budget profit of £500,000. The budgeted sales, budgeted expenses and so on. I've got a budget profit of £500,000. Well, that budget income statement we call the fixed budget. However, although most companies do that, there are, depending on how we're using it, there are two big problems with it. One problem, I think you'd agree, is however carefully, however well you do your budget, it's going to rapidly go out of date. It becomes unrealistic. I say, however well you do it, a silly little example, but while doing your budget, you may have budgeted that, your electricity cost, there's going to be a price increase. You've budgeted on an increase of 5%. Maybe the electricity company does increase prices, but they go up by 15%. Well, of course, immediately your budget is effectively wrong. Now, there are ways around that. What a lot of companies do, in fact, is periodically, no rule again, perhaps every 3 months, go through and update the figures, correct them. But the original budget, you may have budgeted on $500,000, but you'll have to accept lots of things are likely to change. By the end of the year, it could be that all your figures are out of date. Another problem, though, is this. People often use budgets to control. You may have budgeted within the budget income statement. You may have budgeted for spending 200,000 on materials. Don't copy this if you write anything down, but you may have budget materials cost Sorry, this is a second point I'm about to make. But you might have budgeted your materials cost to be 200,000. And a common use of budgets is to control your managers, to check their performance. And if you've budgeted on 200,000 and your manager spends 300,000, you're going to use the budget to compare the two and say, you've spent a lot more than you should have done. What's gone wrong? You've done a bad job. But in fact, that might be very unfair, because it may be in your budget. You budgeted on 200,000, but you budgeted on production of 10,000 units. Well, suppose demand's a lot higher than we expected, and suppose the actual production we actually produced 20,000. Now, of course, if you end up producing twice as many as you originally intended, that could be very good if it's because demand was twice as great. But if you produce twice as many, you're immediately going to expect twice as much cost, surely. And if you actually spent the actual cost of materials turned out to be 400,000, well, it would be ridiculous and terribly unfair when you came to appraise your manager to say, you've spent 400, the budget said 200, you've done a bad job. Obviously the manager's spent more, and I'm not going to be at all surprised if you produce twice as many if he spends twice as much. All right, if he spent 500,000, then something's gone wrong and we need to know. If he's only spent 300,000, he's actually done very well, even though it was more than the original budget. And so there's a second problem that you cannot use directly for control to control costs which vary with the level of production. Now, again, the problem may be easily solved. To the first problem, that it goes out of date, fine. I said most companies do update their budgets. The original budget said 500, turns out to be completely unrealistic. The second problem, do update their budgets. original budget said 500, turns out to be completely unrealistic. The second problem, I hope obviously from my baby example, if you do end up producing twice as many, then if you're going to use it to control your managers, you need to adjust the budget for those purposes. So the problems are solvable, or we can deal with them, but the original fixed budget is just the original budget, which again, for these two reasons, we may need to do things with, but the original fixed budget is the one you initially prepare. And the reason, in fact, it remains important despite those problems, you see, if I've budgeted that next year I'll make $500,000, I accept that electricity might go up much more than I expected. And of course, if electricity goes up, that's going to make profit lower. But surely, I'm not just going to lie there and say, oh dear, electricity's gone up 50%, I'm going to make less profit. As soon as I see the electricity's gone up more than I expected, if I see that's going to cost me 50,000, I won't just sit there and accept it. I'll look for any way I can of saving 50,000 elsewhere. I'll immediately say, oh, if I do nothing, I'm going to lose 50,000 here. So I immediately say, can we use less electricity? Can we go to a different supplier of electricity? If we can't cut the electricity cost, are there any other costs that I can cut? That I'll do anything I can to try and get at least the budget profit. What's important is the original fixed budget profit remains the overall target. Not line by line the cost of the revenues necessarily, but the overall profit. If I can do better than 500, great. But the minute I see something's gone wrong that's going to reduce that profit, again, I'll look for ways of trying to save money elsewhere. Whatever happens, I'm still aiming to make at least 500,000. However, I've said enough there. The fixed budget is your original budget. There are problems, particularly those two, but it does remain the target. But let's look back at those problems. How might we deal with them? Well, what I've already half mentioned. However well you do your budget, it does go out of date. And I said one way of dealing with it, a very common way, is periodically, for a lot of companies, it's every 3 months, but periodically re-examine the budget and simply update it, make it more realistic. You know, you've done your budget January to December. If in February you find there's been an increase in the price of electricity, well, fine. Perhaps at the end of March, rewrite the budget bringing in the correct figure for electricity. Well, although that's very common, another approach, less common I must admit, but in principle a very neat approach, is to do what we call a rolling budget. Now I appreciate if you're looking at page 49, I am doing them in a different order. But a rolling budget is a very neat idea. What it is each month prepare a budget for the following 12 months. And so, perhaps I don't need right, but even so, What you might do, for instance, in December 2009, you'd do a budget for the following 12 months, January to December 2010. But then in January 2010, you'd budget all over again for the following 12 months, for February 2010 to the end of January 2011. And in February, budget again for the following 12 months, so for March 2010 up to the end of February 2011, and so on. So every month you're doing a budget for the next 12 months. Now that might sound an enormous lot of work, obviously. In fact, it's not so bad, because what it means is that each month you're doing two things. First of all, for instance, January. When January you're budgeting for that period, remember, you've already got a budget up to December, so you've already got 11 months. And so what you're doing is you're updating 11 months, which are already there. Clearly you may need to change figures because price increases have been different, but you're updating 11 months you've already got, and you're adding an extra month. So it's not quite as big a job as it looks at first glance. The reason for doing that, there are two huge advantages. One, of course, is it's always a lot more accurate. Every month you're updating, so it's always more up to date. The second advantage, perhaps even more important, is I'm sure those of you who have ever been involved in budgeting, most companies don't do this. Most companies do the budgets once a year. They're doing them under time pressure. They're having to fit it in with their ordinary work, so a lot of work tends to be done in overtime and that sort of thing. And because of that, they're never done as well as they could be. You know, I don't know anybody who's ever done a budget where they've looked back late and they've realised they've made some very silly mistakes because they were doing it under time pressure. Well, obviously rolling budgets take time, but because you're doing it every month, you get much better at it. You know, you get used to it. It's every month. You know what sort of things you're looking for. You get much faster at it, much better, and it becomes part of your normal work. If you know it's going to take a day, then you start programming your work so that a day a month you're going to be doing your budgets. It becomes part of the normal work. Sorry, not because. It becomes part of normal work. And as a result, you end up with better, or I'm not sure it's quite the right word, but more accurate budgeting. You're not doing it under the same pressure because you know it's going to happen. You sort of build it into your time planning. Now, I've already said it isn't in fact that common, but if you've understood me, I think you'd agree it is actually something worth considering. It's quite a good idea. That's what a rolling budget is. The exam, there is no way you'd be asked to prepare one, but certainly, I've already said a lot of any budgeting question is going to be essay writing sections. Certainly you could be asked to explain what a rolling budget is and what the benefits are. The other problem, though, was this second one, if I can find where I wrote it. Yes. that forgetting this rolling budget idea, even if you've done a perfect budget, if the level of activity changes, by level of activity I mean if demand goes up or down, if your production goes up or down, if you produce, as my little example, if you produce more than budget, then certainly insofar as variable costs are concerned, you expect to spend more than budget. And if you're using it to control your managers, it'd be silly. Look back at that little example, I won't repeat it, but it would be silly to compare what they actually spent with what was in the original budget. That if you're using it to compare, you should effectively adjust your budget. You should say, in my example, I was budgeting on what, $20 a unit? And therefore, if I produce more or less units, I expect to spend more or less at $20 a unit. And therefore, produce twice as many, I expect to spend twice as much. Compare what I spent with what I should have spent on that basis. Well, that adjusting of a budget is called a flexed budget. A flexed budget it's where we adjust or rewrite for the actual level of activity. By level of activity, I mean the actual sales, the actual production. The reason for doing it is if we're using it for control purposes. And let me make it hopefully perfectly clear what I mean. Can you turn over and look at example 2 on page 50? It's a very simple example. It's something, again, you should have done in paper F2, but it's too important because, I said before, because of something that comes in a later chapter. A company's prepared the following fixed budget for the coming year. We expected to sell 10 and produce 10,000 units. The costs there, total 97,500, budget selling price $10. At the end of the year, the following costs have been incurred for actual production of 12,000 units. And without reading through each cost, below the actual sales, we sold 12,000 units and the revenue was 122,000. I say it's a very, very simple one. And what we're going to do, well, it says prepare a fixed budget. In fact, what I'm going to do is, first of all, I'm going to write up the original fixed budget. Then we'll make sure you're clear what I said earlier, and we'll do a flexed budget. Do note, incidentally, it says at the very end of the question, use a marginal costing approach. I'll remind you what that is as we do it and what an alternative would be. However, I'm going to do them side by side. If you're leaving space, I'm going to have 4 columns. But first of all, I'll write up the fixed budget, the original budget. And then I don't forget, although it's not part of the actual profit statement, the original budget was sales and production of 10,000 units. So, first of all, sales revenue. Budget selling price, it's budget, remember, so budget selling price was $10, so sales revenue 100,000. The costs, materials, we'd budgeted on 50. Labour, 25. Variable overheads, 12.5. Now then, although I'm not over worried here about layout, just to check on a couple of bits of terminology, well, what would I do? If I stop there, my costs so far are what? 50, 70, 80, 87,500. Well, that 87,500, that's the total of the variable costs. We call that, if you remember, the marginal cost. And so the profit so far, we've got sales of 100. The variable cost is 87,500. So the profit so far is 12,500. That's the profit before fixed overheads. That, remember, is the contribution. However, there are fixed overheads of 10,000. And so the final budget profit, 2,500. Now say, I'm not over worried about layout. Set it out differently, whatever happens. You know, revenue 100, total cost 97.5. The profit is 2,500. It's just that I didn't want to waste it. In all sorts of places in the exam, marginal cost, variable cost, and contribution are important terms. Well, I probably hardly need to say, but if I'm using this for control, ultimately we want to compare actual costs with budget costs, but, and don't copy this down, materials, for example, further down, we actually spent 60,000 on materials. Well, it would be dreadful, unfair, ridiculous to compare 60 with the budget figure of 50. Why? It's because at the end of the question it says, I beg your pardon, above the second table it says we actually produced 12,000 units. And of course, even if the manager did his job perfectly, if you produce more units, you'll expect to spend more money. And so all the flexed budget is we simply rewrite the original budget, but on the actual level of activity, which was sales and production of 12,000 units. So, using budget costs, budget selling price, let's rewrite it based on 12,000 units. Sales, first of all, the budget selling price was $10. With 12,000 units, it means the budget revenue should have been 120,000. Materials. I've chosen easy numbers here, but in the original budget it was 50,000 for 10,000 units. It was $5 a unit. If we produce 12,000 units, well, at $5, we'd be expecting to spend 60. Labour. Original budget was 25 for 10,000 units. It was $2.50 a unit. For 12,000 units, therefore, you'd expect to spend 30,000. And variable overheads. 12.5 for 10,000. You were budgeting on $1.25 a unit. 12,000 units actually produced at $1.25 comes to 15,000. And so the variable costs, I would expect for our actual production to spend 105,000. I would therefore be expecting a contribution of 15,000. Fixed costs, of course, by definition, shouldn't change with the level of production. And therefore, you'd expect them to stay at 10. And so there's the rewritten, the flexed budget. For our level of activity, we'd be expecting a profit of 5,000. Having done that, now it's valid to start comparing what actually happened with the budget and see whether the managers have done well or badly. Let's look at the actual results. Of course, it was 12,000 units. The actual revenue, 122,000. We actually did well. We got more. We must have sold at a higher price. And the actual materials, 60. Fine. Not good, not bad sort of thing. We did exactly as we expected. Labour. We've done rather well for the level of production. Even though we spent more than the original budget, for our level of production, we'd actually spent less than we'd expect. Variable overheads, 15, exactly as we'd expected. And so the actual total cost, 60, 80, 90, 103, 500. The actual contribution, therefore, 18,500. Finally, fixed costs, well, they should have stayed at 10. We've actually spent 11. It seems as though something's gone wrong. But the final profit, 7,500. Now, I hope very clearly, comparing actual with original fixed budget would have been unfair. Compare it with flexed budget, and here we genuinely can say the manager's done badly, they've done well, they've overspent, or they underspent. And in fact, standardly, and this is part C, part B of the question, standardly to check, we'd look at the differences. Well, very quickly, just as a little check on terminology, as something that those of you who did paper F2 should be more than happy with. But for all of you, when we look at the differences, we call them the variances. Variance simply means difference, but in each case the difference between the actual result and the flexed budget. So sales, 122 is against 120. There was a difference of 2,000. The other bit, though, that should be a revision, but later, I'm not worried here, but later becomes very important, is, of course, that difference here. We've actually done better than budget. It would give us more profit. Equally, we could have done less, got less revenue than budget. We'd have got less profit. Well, in the exam, when we're looking at variances, we don't put pluses or minuses or brackets or anything. We use letters. If we've done better than budget, if we're going to make more profit, we write against it the letter F. F stands for favourable or more profit. So, on sales alone, 2,000 more revenue, that would result in more profit. Materials, there's no variance. We spent what we should have done. Labour, we spent less. We saved 1,500. Well, of course, if we spend less, again, that would result in more profit. We've done well, it's favourable. Variable overheads, no difference. But finally, fixed overheads. Fixed overheads, we overspent. And of course, if we overspend, we get less profit. Well, again, rather than put brackets or negative signs, we write against it the letter A. The letter A stands for adverse, or less profit. Now, say for this chapter, I'm not too worried. This was more just explaining what flex budget is and its purpose. But later, when we do variances proper, then the F's, the A's become more important. And of course, as a double check, the total of those should explain the difference between actual profit and flexed profit. And does it? 2,000 favourable, 1,500 favourable, 3,500. Less 1,000 adverse. The total of the variance is 2,000 favourable, and that does explain. It does double check. So, there's a very simple variance question. Again, from F2 you'll know the variances can end up being a lot more complicated. But that and the extra bits for F9 come in a later chapter towards the end of the notes.